The main objective of this seminar is going to be twofold. The first is going to be that when we are done with the seminar, you'll be having some details and some idea as to what are the different investment options which you have for your tax saving, which you can use. And the other one would be there are alternate options also through which you can go ahead and save tax, which you will be able to see when I present. The discussion outline is what I have marked for you. One is insights on saving money. That is one. Second is going to be the avenues of investments. Third is going to be the tax saving options. And fourth and the last one, which is very important for all of us to understand, is the financial health, which we all struggle with sometimes in our life, but is very paramount for us to understand. So insights on saving, let's understand what is the thumb rule on insights on saving. All of us have income. Income can be in the form of salary. It could be through the form of rent. It could be in the form of any business which you undertake. So when you have income, obviously you have some money which is coming your way. Post that, you need to go ahead and very clearly identify the kind of expenses you have in your life. Once you have earmarked them, you simply minus your income from your expenses, and what you get is something known as savings. This is a very important calculation which you need to do, because once you get your savings, ideally which should be close to 20 to 30% of your total income, they need to be put into use. When I say they need to be put into use, is savings in your bank are of no use. You have to park them into different investment avenues which will generate money. There's a very old saying in our life. It says money pulls money. So it's very obvious that when you are you have got a certain amount for savings, you're supposed to go ahead and park it into multiple investment avenues which are available to all of us. Do our due diligence in the same, see our goals in life, see how we are placed in terms of in our life, in terms of age, demography, and then go ahead and choose the right investment avenue to park your money. Well, there are various investment avenues which are there, where they help you to grow. If you are young, you can go for riskier investments. If you are a little older, you go for less riskier investments. And the logic is very simple. When you talk about risk assessment or the risk analysis of any product, the longer the time frame you have, the risk part of your investments get mitigated to an extent. So if you're a 23, 24-year-old, 30-year-old, you can have a longer period of investment in risk assets. But if you're closing on to your retirement, 55, 60, or even around 50 plus, you should start relooking at your asset allocation and start using debt, which is a little bit more lower in terms of risk for your investments. How you go about which are the ones, our life starts when we start earning for the first time in our life. The first goal which we look at is tax saving. So the first investment which majority of us do in our life is related to the tax saving options which we have, like under section 80C, which I'll be discussing going forward. So I'll be elaborating few on those which you can use in your life. Then there is PPF, which is the Public Provident Fund, which you can open with any of your with State Bank of India or ICICI Bank. This is not EPF. EPF is different. Okay. Employee Provident Fund is different and PPF is different. You can also have a PPF account where you can park your money. Up to 1.5 lakh rupees is what you can park there. Minimum amount is I think 500 rupees every year. The good part obviously being that after 15 years, it's got a 15-year lock-in period, but after 15 years you can extend it for the next 3 years by 5 years. PPF should be seen as a very important investment avenue for all of us when we start post-tax saving. Mutual funds, all of us, I'm sure, are investing in mutual funds right now in some way or another, and they are one of the mutual fund hai to sahi hai. We all have heard about that, but you need patience with mutual funds also. So be very specific where you're parking in mutual funds. Are you using equity mutual funds? Are you using hybrid mutual funds? Are you using debt mutual funds? You can also park in commodities when you invest through mutual funds. There are multiple gold funds which are there. You can park your money through mutual funds in international funds also, which are US based, Japan based. Okay, then there are companies which are into gold mining. You can use mutual funds to invest there too. There are ETFs where you can park, through mutual funds. So there are multiple types of mutual funds which you can look into when you start your investments. The best part being, I'm aware, like in terms of tax saving, as low as 500 rupees can be your monthly outgo, and then depending upon your investment, that's your income minus your expense. Savings, how much over savings you have, you can park into all these avenues. So mutual funds, pay attention to them. Equity, there are multiple: large cap, mid cap, small cap. There are multi caps also which are there, which are doing well. Debt, you have income funds, you have bond funds, you have duration funds, you have credit risk funds, you have GSEC funds. Then you have obviously, then you have commodity, which I've told, gold, which you have, and the others which I mentioned. So park, select, and make sure you do your due diligence when you start parking your money, and have patience. They take a lot of time. Insurance, insurance is considered as a product in India, unfortunately. So I have a lot of investors which are abroad, out of India, which I keep interacting with, keep talking to. And insurance should not be considered as a product. Insurance is more of a safety net which you create for yourself in life, be it health, be it life. Some of you would be comfortable by parking your money into endowment plans, and also uh, you know uh, sometimes ULIPs which are there. So insurance is a more of a protective way of investing in your life. It should be a part of a portfolio. It should not be something which is which you're only being specific to mutual funds, or only PPF, or or tax savings. So insurance should be there. It gives you safety. You should all have a term plan ideally in your life. There are certain calculations which you should do when you're picking up a term plan. Part of a portfolio should also have endowment plans. You should have them. Might sound very cliche, but you should have. Direct equity is a share market, the Bombay Stock Exchange and the National Stock Exchange, BSE, NSE, where you can park your money directly, buy shares. Now there are companies which are offering you to buy shares in US also directly, so you can go ahead and buy Alphabet. You can buy you can buy Netflix. You can buy your Visa. Visa is one of the company which I am parking my money in, because I like that company. It's one of the top companies, though it has got a lot of competition from you know uh, portals also right now. But I think Visa will still do very well going forward. Postal schemes, we have all have heard about postal schemes. You have Kisan Vikas Patra, National Savings Certificate is what you get from the postal department. These are small time saving schemes, but they give good returns if you have that kind of mental framework to be to go to these companies, and to the post offices and invest in them. Believe me, you should. There's nothing wrong in them. They are a good avenue at the end of the day. Fixed deposits, though the rates have gone down drastically over the last 4 5 months, but fixed deposits also come across as a good option. They are also under Section 80C considered. I'll let you know how. So have a small portfolio in fixed deposits also, specifically if you are in a low income category where your income tax is less than 10%. Corporate deposits are also a very good option. They give you interest rates which are slightly higher than fixed deposits, though they are very they can be risky. So you please need to do your due diligence. You need to go ahead and see the kind of ratings they have. In terms of CRISIL is one of the CRISIL rates them. You have S&P which rates them. So use those options also. Like HDFC Limited is one of them. They are good. Then you have, I think, you have Muthoot Finance. So though they give you higher rate in terms of interest than FDs, but they're a little riskier. So you can use them too. Fair enough. So I'm now going a little bit more forward. I'm going on to your tax saving options. I'll be taking you along with me for the different with the different options you have. Ideally, this is the first step of investing money. Okay. So let's see what are the options we have. There are various ways to manage your tax savings. You have the public provident fund, which is there, PPF, which I told you, which you can open and you can deposit your money. Under section 80C, up to 1.5 lakh rupees which you park into public provident fund will be earmarked as tax saving option, and you don't have to pay tax to that extent. Plus the money which you earn out of the PPF account is also tax free, so that's another great advantage which you all have if you put your money in PPF. It has a 15-year lock-in period, but from the 6th year you can remove 40% of the money which you have parked for the first 4 years. So you can have part withdrawals, but technically up till 6 years you're going to be locking in your money. But it's a good option nevertheless. EPF, I'm sure all of you would be having a employee provident fund. Your contributions which are done to this fund can also be considered under section 80C, so please keep that in mind. And it's a very good corpus which grows over a period of time. Whenever you switch your companies or go to some other company, I'm just going a step ahead and just talking about it, you should always transfer your EPF account and continue parking money there. It's an important aspect. That's something which is more like a retirement corpus, which you build in your life, which is very important, which gives you passive income. I'll explain that later during the presentation. National Pension Scheme. Now, this NPS is under another section, but nevertheless, up to 50,000 rupees when you park into an NPS, it gives you, further tax savings, so which is, a very good option. I hope your company is enrolled with the same. You can use that. National Savings Certificate is available from the postal schemes. Your post office, you have to go to them. You have to just buy them out from there. Um, uh, what happens is you don't get interest paid every year in National Savings Certificate. It gets paid to you directly after the end of 5th year, so you've got a good corpus which comes your way. So there is compounding of your interest which takes place in a National Savings Certificate, so you can use that. It's a very safe, extremely safe haven in terms of parking your money. It can be used and should be used if you want. You have your ELSS schemes, those are the equity linked savings schemes. They have a lock-in period of 3 years, and what it means is you cannot really remove your money up to 3 years from the first day of your investment. I come across many questions from my investors when they ask me, okay, I had parked through an SIP in an ELSS scheme, Rahulji, and now we want to remove our money, or markets have become well, shall we remove our money? Of course you can remove the money, but you need to understand what you've parked in Jan 2017 is only going to mature on December 2020, because it's a SIP, systematic investment plan. So first in gets calculated with your 3 years, so you have to calculate. So Feb will get Jan 2021, so that's how the calculation is supposed to be done. So be mindful of that. ELSS schemes are equity. In this case, you are taxed till 2018, 31st Jan. So till 31st Jan 2018, whatever money you have parked is under the grandfathering clause. And suppose that whatever money you make as short-term capital gain is straight 15%, and long-term capital gain, because it's a 3-year lock-in period, then it's going to be long-term capital gain. You're going to be not taxed up to 1 lakh rupees of profit booked, but beyond 1 lakh rupees, you're going to be taxed 10%. So I'm giving you the nuances in terms of the funds or the investment options for under section 80C and how they are taxed further. But ELSS schemes are the lowest lock-in period product, and so far they seem to be one of the best return generators over a 7 to 10 year period. So look into them. Unit linked insurance plans and even your normal insurance plans are also a part of your tax savings. So if you have invested in any endowment plan, any ULIP, or any of the term plans, the premium which you're paying, so specifically the premium which you pay every year, is going to be considered under section 80C. Please understand, it's a cumulative of all of them. It's not like every each and every option 1.5 lakh rupees. So you can have 20,000 in PPF, 20,000 in EPF, 20,000 in NPS, 20,000 in ELSS, and 20,000 in units. So that the totality, the summation of all of them cannot be beyond 1.5 lakhs. So unit-linked insurance plans are also there as an option. I'm sure a few of you would be having them. Out of the unit-linked insurance plan, the amount which you get at the end of the period is also tax-free. Sukanya Samriddhi Yojana is for all you parents who have got a girl child. Please go ahead and park good money for them there. You almost get a good return of 9%. It's an excellent scheme to park money in. Your girl child will get good money when she turns 18 and also 21. It's got a good interest rate. 9% is an exceptionally good interest rate for all of you who have daughters, and make the most of it is what I would suggest. Park some into this also, because the money which she gets is going to be tax free. Yeah, so keep that in mind also. So this is under section 80C. Options for investments, all of them can be used in accumulation, but the addition has to be 1.5 L at the end of the day. Okay, fair enough. I'm moving forward. Now I'm going to your other investment options. There it is, NPS under section 80 CCCD, which is National Pension Scheme. Up to 50,000 rupees for you can park, so that's like 4,000 rupees a month. You can start off with your company. It's a good option. The only thing is you cannot get any money out of these guys till you're 60, and when you're 60 you will get 40% of the money, and the 60% of the money which is accrued will be kept in any of the investment avenues which are available at that point of time. But it's just like it's just like any like in USA you have these small funds, pension funds, where you really cannot remove money, and you get them only at the end of a certain age, which is 60 there also. So that is assurance which you have, that okay, you'll have some money which is going to be available to you when you get old. We generally end up spending a lot of our investments and savings, so that's one way of looking at it. Your health insurance premiums will also come under section 80D. So whatever premium you're paying for yourself and for your family, 25,000 and up to 50,000 can come under your health insurance premium, so 80D. So please mark them also when you're filling up your return form. Don't miss out. If you have any kind of an education loan, the interest which you have paid over a period of 1 year is fully deductible under section 80E. So please use that. It's a very good option again if you have any loans and you're paying EMIs for the same. Then you have your interest component of home loan, which is 24E. Many of us will be having a home loan. So under section 80C, the principal amount can also be used, and in terms of the interest amount, up to 2 lakh rupees can be used for 24E. So make most of it if you have a home loan going on. So that's interest payment, repayment of home loan for your first time owners, by the way. So keep that in mind. You can't be buying multiple houses and using this. So it was for the first time owners. Rent paid in cases where HRA isn't paid is 80GG. You can always consult your HR and get some more briefings on the same. Interest earned from savings bank account under section 80TTA up to 40,000 rupees, that is. So if you have a FD or you have a savings account, the money which you are earning up to 40,000 rupees is going to be not taxed. That is under section 80TTA. The medical expenses towards if you have a disabled dependent, I hope none of you have, but nevertheless, if you have, you can always use 80DD for the same. I hope you guys do donations in your life to charitable institutions. There's a very old saying which goes like, charity begins at home. But nevertheless, if you are associated with any of the charitable institutions, you can use these donations for the same. Okay, 80CCC. Well, so that is a tax, various ways to manage your tax savings, additional ones which you can look into, use, and make your money work harder. So next we go on to your something which how we assess your financial health. Um, I wanted to really broach this topic with all of us for this presentation, is because we are working so hard in our life. We are going through tough times in our life. 2020 has not been very, very kind to us any which ways. To some it has been exceptionally kind. Obviously there are cases otherwise also, but nevertheless so it becomes very important for all of us to just sit back, sit down, and assess the kind of financial health we are in our life. There are certain areas which you need to dwell upon when you are assessing your financial health, which I'll be talking about, and it's very simple. I've tried to keep this as simple as it can be, for understanding purpose and for also implementing purpose. um, you need to determine your net worth in your life. What do you mean by net worth? So the simplest of definition of net worth is you go ahead and understand what all your assets are, and from your assets you really go ahead and deduct your liabilities. Let's be very very functional about this area. Assets are something which you own that can be financial and real, so it could be gold, silver, real estate, your investments in mutual funds, direct equity, all the ones which I have mentioned to all of you. So those are the assets which you have, and the liability could be any kind of mortgage, any type of loan. It could be a home loan, personal loan. It could be your, your education loan that comes under your liabilities. One When you simply deduct your assets from your liabilities, what you get is something which is known as your net worth. Very important that this net worth is a positive figure. Many times in our life we go ahead and create assets by picking up liabilities, like we would go ahead and take a loan for our education. We might go ahead and pick up a house by taking up a mortgage. We could go ahead and pick up a personal loan and end up investing it. So those are good loans, or good debt is what we call them. These are the debts which we are using to enhance our value, and they create value in our life. So, but you have to be very calculative. Many a times, when we go in for a higher, asset built up by taking a huge liability, if the repayment or prepayment is, goes wrong, we can end up, really having a very huge negative net worth. So you have to be very calculative and very, very, I would say, sensible about how you pick up debt in life. Bad debts is basically your credit card bills, fringe, spendings which you do and you end up paying on your credit card, which do not add value. So avoid them as much as you can. Uh, the long and short of it is, by the age you by the time you turn 45, 48, you should ideally not have any not much of debt on your head, ideally. But I think by 55 surely you should be totally out of debt, because that's when you want to start your passive income in your life. So please pay attention to this slide, which is talking about the net worth. Higher the net worth, the better you are placed in your life. So it is nothing but your asset minus your liability, and these are the parameters which you look into when you're calculating the same. Yeah. Um, okay. Uh, there are multiple ways of getting rich in life or having a good net worth in life. One is your income keeps growing exponentially. Well, when I say exponentially, I mean, yeah, you should be like, either born with a golden spoon, or you should be having that ability to be right at the top of the pyramid. So when you're right at the top of the pyramid, you really don't, you're very few of you who are like, doing things which many people don't know. So you're paid well. Some businesses, some business owners are doing exceptionally well because they have businesses which are running for ages. What happens is, income is something which can be sometimes be a little subjective in nature, but there is one control mechanism which is there in our life, which is called expenses. So expenses at any time should not be more than your regular income. That is a thumb rule. You don't want to be having an empty wallet in your hand when you are moving out of your house. Only having credit cards is not the best thing to do. So it's very important that these tax saving investment avenues which are there up to 1.1.5 lakh rupees plus a little bit more, you need to keep building on them, adding on them, because expenses are something which eat away your saving. Expenses are something which eat away your future savings also. If you're an avid credit card user and you keep rotating your balances every month, just paying the minimum balance on your credit card is a very wrong thing to do. ideally you should never do that, because it's the most expensive credit you can buy in this world. So be very mindful of your expenses. Sit down, take a paper, sit down on your computer or laptop, go onto an Excel sheet, mark your expenses one by one, so that you can understand where are these expenses which can be reduced, or are capable of being totally deleted, so that you have a higher amount of savings. So please determine your expenses. Firstly, obviously your net worth. Determine your expenses, very important. One of the goals which is going to be incumbent on all of us, which we all are going to go ahead and face, is something which is known as retirement planning. Planning is nothing but passive income. Uh, I subjectively attach retirement as a mindset rather than age. Uh, what it means is, retirement is when I'm not working, I'm not actively participating to get money at the end of every month, be it through your salary or business. I might not be working, I might be just enjoying my life every month, and I have got money coming into my bank account every month. So that's passive income. Retirement is ideally a time wherein our physical inability to perform tasks would mean that we need money coming our way. Okay, but that's not necessarily. It's not necessary that we wait for that long. Okay, I mean, you can retire faster. You can go ahead and use your investments purposefully to reach that level wherein your expenses plus your lifestyle is managed by having a good passive income. You need to do planning for that. You need to have a good net worth for that, and it is very much possible. It's just about application of your mind and your efforts. So very important. It's an incumbent goal which has to be taken care of, which is retirement planning, passive income. Very important. So generally, the first goal which you look at is tax saving. Second goal which you look at is your retirement planning, which is very very important. So you have to keep working diligently towards these two goals. Planning for keeping your emergency fund aside. 2020 would have really shook many people up, and the ones who have still survived this period would be the one who would have kept some emergency or a contingency fund available with them during this time. They would have actually eaten into their emergency or contingency fund. Thumb rule: emergency or contingency fund is not your investments. Investments are different. You have an emergency or contingency fund which is separate from your investments. Uh, they're a part of an investment, but as the name suggests, it's an emergency or a contingency fund which is used specifically, not breaking your investments, but using this money for your monthly expenses. How much should you keep? Well, go ahead, go on to the third point. Mark out the kind of expense you have monthly, multiply by 4 months to 6 months, and so that's what your emergency and contingency fund is. The reason we say 4 to 6 months is, the global averages tell us that if someone loses a job or is out of bounds from his normal income, he will take around 4 to 6 months to basically go ahead and come back on his feet. So that is the kind of time taken for you to be able to push yourself for that 4 6 months. So this fund basically helps you for that one. Second, your emergency contingency fund would help you for any kind of health emergencies or any kind of family emergencies which can come your way. So you don't have to dip into your investments, because you might have parked into equity, and equity markets would have been low at that point of time. So you'll end up really making a mess of your investments and your goals. So that's the reason. Keep this in mind. Plan for your emergency funds for sure. 6 months, 4 to 6 months into your monthly expense. That's the thumb rule. Um, I would want you to pay attention to this slide, because this is how your net worth breakup should look like. Again, we keep telling people and harping on people that it is very important to have some percentages which should be attached to your net worth. So how do they work? Your liabilities like loan and mortgages should not be beyond 30% of your income, ideally. Your expenses should not go beyond 40%, ideally. I'm using the word ideally because many times it does not work that way, but nevertheless you should aim and target to reach that kind of a level. Your investment should be at least 20% of your income, and your cash savings account should be at least 10%. So 40 plus 30 would be 70%. So 70% you can earmark for your liabilities, loans, mortgages, your expenses, but you should at least target to invest 20 and have savings or your emergency contingency fund, which comes to cash savings. um, as you grow older in life, as you age in life, the prime age of making real good money has been earmarked between the age of 38 and 52. That's a global average which I'm talking about. So here what happens is your liability and loan mortgages almost fall to 10%. Your expenses are only 10 to 12 to 20%. Your investments are as high as 60% of your income, and your cash savings are close to 10 to 15%. So that's where you have to reach ideally. The faster you reach that ratio, the better. This is the ideal ratio which you should be at any given point of time. So you should plan your net worth breakup in this manner, which helps you going forward. It's a discipline, it's a number, it's a percentage. So you can keep varying it. And wherever you think you are falling short, you have to immediately retweak it and make it, bring it back to the one which we are discussing on this slide. Okay. Well, thank you so much. Keep watching, keep learning. The main idea at Wellsmith Talks is to give you knowledge and empowerment to take decisions. Thank you so much.